Hey everyone, thank you for joining tonight's presentation, San Diego Real Estate and Economic Update. Tonight, we're going to take a look at what we have to look forward to in 2024, and we'll also take a look back at 2023 to see where we came from and where we're going. I know that there's going to be a few more people probably logging on throughout this, but for the essence of time, why don't we get started? First, a little short background on myself. My name is Patrick Kappel. I am the team leader of the Kappel Realty Group, a brokerage team based here in San Diego. I have a little over 15 years of experience in the San Diego real estate market. I'm not just a employee in the world of brokerage, I'm also a consumer. I buy real estate myself in San Diego, and between my wife and I, we own 8 properties. To date, in just the last 5 to 6 years, the team, Kappel Realty Group, has sold nearly $500 million, over 750 units in San Diego real estate. So along with working in the business, my team also has a lot of experience, some of which we'll share with you today. And I serve in the military. I've been in the military now for over 24 years. I did 11 years on active duty and the rest in the Navy Reserves. The education you can see there in the middle, and a lot of what we're going to cover tonight comes from an educational background. I have a couple of goals tonight, and one of them is that at the end of tonight's presentation, you walk away from here knowing more about the San Diego real estate market and why it's the way it is. Why are prices where they're at? Why is inventory where it's at? And what is likely to happen with San Diego real estate? By the end of tonight's presentation, at the very least, you should be able to make more confident decisions for yourself as you move forward. So with that educational perspective, there's a lot of data and information I'm going to share with you. You can see in the center there that I have a master's degree in real estate, an MBA with a focus in finance and entrepreneurship, and also a bachelor's degree from the Naval Academy. So it's a lot of that business and real estate background that we'll share a look at today's market with you. You can see a lot of the awards on the right-hand side there. Our team, the Kappel Realty Group, is not only one of the top performing teams in San Diego, but one of the top in the nation. And the one last short little plug that I'll give on my team is at the end of tonight's presentation, if you're thinking of buying or selling real estate, certainly reach out to my team. And I ask you that not for my good or my team's good, but for your good, because when you're making the most important financial decision of your life, which is often buying or selling real estate, you owe it to yourself to work with someone, and not just someone, but a team of professionals that can help you with what can become a very complex journey, and that's buying and selling real estate. Our team, the Kappel Realty Group, is here to help you. And hopefully over the next 90 minutes, I don't just tell you, but I show you that we know what we're talking about with real estate. And at the very least, I want to impart upon you some knowledge that you don't have yet about what's going on in the San Diego real estate market. And after tonight, if you have any further questions, of course, you can always reach out, email me directly at patrick.kappel@compass.com. You see it in the top right. And if you have other questions about other topics like investing in real estate, or how can you get free money, down payment assistance to go out there and buy California real estate, then take a look at some of the webinars that we've recorded and uploaded on our YouTube channel. Very easy to find. Just go on YouTube, type in Kappel Realty Group, as you see circled there in red, and you'll see dozens of other webinars, including tonight's webinar, which will get uploaded in the next 24 hours. So if you know anyone, family or friends that could benefit from what we covered tonight, feel free to just share with them tonight's presentation on the YouTube channel. And with that, let's get into it. I always like to start my presentations by letting you know I will answer 100% of your questions. So if you have any questions, feel free to type those into the Q&A. And again, if you have any questions after tonight, you can always shoot me an email. I'll answer all questions tonight at the end of the presentation. I often find that sometimes I answer the question during the presentation when the question comes early, but still, please type it in the Q&A and I'll make sure I answer it at the end. Tonight, I wanted to add a few bullet points I haven't had up here before. And these bullet points give us a quick snapshot of where we were and where we're at. And by where we were, I mean in the last 12 months. And you can see that at the end of 2023, the weekly average of the 30-year mortgage dropped from 7.79% to 6.61. As of today, we're around 6.8 plus or minus, but you can see in just about 2 or 3 months, mortgage rates have already dropped a full 1 percentage point, and they're likely going to continue to drop more. Why is that? There's a myriad of reasons. One of the base reasons, though, is CPI. Core inflation is starting to decline. And when that consumer price index starts to go down, it signals to the market that the Federal Reserve will likely begin lowering the Fed funds rates, which can lower the 10-year Treasury rate, which in turn will lower the 30-year mortgage. So one thing that we certainly will see throughout the remainder of 2024 is mortgage rates going down. We also saw something pretty phenomenal last year outside of real estate, but still in the world of finance, and that's the stock market. The S&P 500 had one of its biggest years ever with a 25% year-over-year gain. And the NASDAQ had certainly one of the best years ever, going up 45% in just 1 year. By all accounts, it was quite amazing that we saw home prices go up and the stock market go up as much as they did in one of the highest interest rate environments we have certainly seen in the last couple of decades. And with the stock market and home prices going up as much as they did in 2023 with high interest rates, imagine what's going to happen to financial assets like housing when interest rates go down. They'll certainly continue their upward trajectory. Home values did hit many new peaks in 2023, and we'll likely see some new peaks in 2024. One thing, though, that was a challenge is the number of new listings. There's so many homeowners, which you'll see in a future slide, that are sitting on interest rates in the 2, 3, and 4% range that they're not incentivized to sell, and thus there's a lot of homes simply not coming to market. So I'll start with a few headlines tonight. The first one, top housing markets for 2024. There's a recent article that came out showing some of the top markets, the 10 top markets for 2024, and San Diego is ranked amongst the top 5. In fact, half of the top markets for 2024 all exist in Southern California. So what are these top markets throughout the country in this coming year? You can see them right here laid out in front of you. Again, over half of them on the West and specifically in California, and San Diego falling in on number 4. There's a lot of numbers going across the screen for you. So what are these numbers showing? The first column showing that in San Diego, we're expecting there to be 11% more sales than what we saw in 2023. When we compare 2024 home sales to the averages before COVID, 2017 to 2019, we're still looking at about 31% less sales. Why is that? What I just mentioned, what we call the mortgage lockdown effect. There's a lot of homeowners that just simply don't want to sell their homes because they're sitting on low interest rates. So there's less transactional activity, but we're still looking at more for 2023. The big one, though, for you to be aware of, especially if you're thinking of buying a home this year, is the median home price in San Diego is expected to go up by at least 5.4% this year. What does that mean for you if you're a prospective home buyer? This means that the longer you wait to buy a home, the more you will pay. And in a future slide, I'll show you just how much more likely month over month. As I mentioned already, we're seeing mortgage rates come off of their peak. Mortgage rates peaked out around 8% plus or minus late last year. And as we went into January 2024, we saw them come down through 7 and now into 6%. And as of today, the 30-year mortgage is sitting a little bit above 6.6. This is as of January 18th. As of this morning, we're around 6.8%, plus or minus. Not a bad rate considering last fall we were around 8%. And as I mentioned earlier, mortgage rates are following because of expected actions within the Federal Reserve this year due to falling inflation. Inflation, the consumer price index, has been the buzzword for the last 2 years, and that peaked out also above 8%. And we've seen it drop quite a bit in the last year or two, sitting now around 3.4%. And the Federal Reserve wants to see it around 2%, which will likely get to or close to later this year. With inflation coming down, what you see in front of you now is the expected Fed funds rate. Now, if you're thinking of buying real estate, why is the Fed funds rate important to you? Because this is the rate the Federal Reserve uses to lend money to banks. And it's also the rate that the 10-year Treasury, a investment bill, is based off of. What does that matter to you if you're buying real estate? Well, as the federal funds rate goes down, the 10-year Treasury goes down. And the 30-year mortgage is really based on the 10-year Treasury. So as we see the 10-year Treasury go down, we also see 30-year mortgages going down. Taking all that into consideration, what does this chart in front of you translate to as a prospective home buyer? Well, we see here that over the next 2 years, it's expected the federal funds rate will drop almost 2%. The way you can translate that is the 30-year mortgage will also likely drop about, if not more than 2% over the next 2 years. And if we're sitting around 6.8% today, that means we'll likely be in the high fours 2 years from now. In fact, even by the end of this year, the federal funds rate is expected to drop a full 1%. So it wouldn't be surprising if by the end of this year, we're in the high fives or low sixes on mortgage rates. Now, you're going to see in some future slides how that can affect your purchasing power, but also how, as rates go down, home prices typically go up, meaning the longer you wait to buy, the more you'll likely pay. So those are some of the big headlines that we're going to dive deeper into tonight. The first 10 minutes here, we just kind of covered an overarching picture. And I always like to share this slide that most real estate agents, and I'm one, know what's happening in the market. Now, the difference between most agents and good agents is good agents understand what's happening in the real estate markets. And last but not least, great agents can explain to you what's happening. With a master's degree in real estate and over $500 million in sales, I like to think I'm a great agent. And what I'd like to do is spend the next 60 minutes or so explaining to you what is happening and why it's happening. You see, at the end of the day, a lot of people say they don't have real estate crystal balls or some magical thing they can look into to determine what's going on and what direction things are going to go. Well, the truth is I do. It's called data and analytics, and I'm going to share that data and analytics with you tonight so that you know what is happening. At the end of the day, home prices are continuing to go up. In fact, faster in San Diego compared to most other cities. We're going to go through why and explain how you can take advantage of it. Now, the why we all know. We got to dig in the numbers though, but the why is because we have a lack of supply relative to demand. There's just not enough housing out there for the amount of people that want to buy a house nationally and certainly in San Diego. So the explanation is what we're going to dive into tonight. So let's take a look at tonight's main topics. As I mentioned earlier, we're going to take a look back at 2023, where we came from. And at the same time, we'll take a look forward to the next 12 months. What is likely in store for 2024? Is this a year that you shouldn't do anything? Is this a year you should buy real estate, or a year you should sit tight? If you are going to buy, when should you do that? We got some charts to share with you on that. We'll also talk a bit about the San Diego economy and how that's affecting San Diego real estate and home prices. And we'll take a look at the supply side of the equation, San Diego housing. What I do want to warn you about, it's not as much of a warning as a precursor or get ready to put your thinking caps on. I know it's a Monday. I know it's the end of a long day, and we had a lot of rain in San Diego today, but get ready for a very intense data presentation. Because at the end of the day, I always say words can lie, but numbers will show you the truth. So we're going to take a look at a lot of numbers today and a lot of data so you can see the truth of what's going on in real estate. At the end of the day, we don't have an interest rate problem. We have that housing inventory problem. And we saw that play out last year when we saw interest rates hit the highest levels they've been in over 2 decades, but home prices kept going up. And it all came down to this sentence: we don't have interest rate problems. It's a housing supply problem. And as you all remember, maybe from high school economics class, supply and demand is the most powerful force in nature when it comes to the price of anything. And if you don't have enough supply relative to demand, prices will go up. That's just Econ 101. So what's the bottom line? There's not enough real estate supply, and because of that, there's no crash on the horizon. Not at all. There's not enough supply. And anyone telling you that there's a real estate crash on the horizon, stop listening to that person. They don't know what they're talking about. Over the long term, real estate prices will keep going up, and likewise, rent will keep going up. So if you're a renter, I got a couple of charts to share with you tonight as well that discuss rent and the difference between rent versus owning. Now is a good time to buy real estate, especially now as interest rates are likely to continue going down. So let's take a quick look at some recent headlines from the last 6 months or so. The first one here came out from the LA Times, saying that there's only 3 primary solutions to our housing crisis. Number 1, build more housing. Number 2, build more housing. And number 3, build more housing. I think you get the picture. And then when we bring it a little bit closer to home, the San Diego Union Tribune, we see that in 2023, San Diego home prices were the second fastest rising in the nation. Now, I'd like to combine this with an article I'm not going to share with you because it was an awful article that was completely wrong by a company that isn't always that correct. That company's name is Goldman Sachs. You see, in January of 2023, 12 months ago, Goldman Sachs put out a prediction that San Diego home prices were going to crash by more than 10%. And Goldman Sachs couldn't have been further from the truth. Not only were they wrong in the sense that last year San Diego home prices didn't crash, but San Diego home prices went up by nearly 18% last year. In fact, I recall when that Goldman Sachs article came out, I looked at my team and I said, team, they are wrong because nobody knows San Diego real estate the way we do. Why is that? Because Goldman Sachs does not have analysts on the street in San Diego, in the market, going to open houses, seeing 10 offers on a property, seeing the lack of inventory. As much as Goldman Sachs is a big name in New York City, Goldman Sachs does not understand San Diego real estate because they simply don't have the boots on the ground. And we saw San Diego home prices skyrocket last year. In fact, we saw San Diego County properties hit record levels of valuation, with the entirety of all land values in San Diego last year hitting $727 billion last August. Now, a lot of people also get this misconception that everybody's moving out of California. Well, the truth is, there's also a lot of people moving to California. In fact, almost 500,000 people, 475,000 people, moved into California last year. And which state did they come from? This might surprise you. It was Texas. You see, there's this misconception out there, partially right, but a misconception. And the misconception is that everybody's moving from California to Texas. Well, the truth is, there are a lot of people moving from California to Texas, but there's also a lot of people from Texas moving to California. In fact, people moving out of Texas moved to no other state more than California. We're doing what I call a human capital exchange. The people moving from California to Texas are the ones that can no longer afford California for the most part. The people moving from Texas to California are the ones that can afford California. So what does this mean? Texas and many other states are sending to California their brightest, youngest, highest paid individuals that are coming to work in biotech in California. And with that, there's a bit of a brain drain happening in Texas, and a lot of that human capital, if you will, is moving to California. Now, the challenge is California homes are already expensive. And because the brightest, highest paid wage earners from across the country, including Texas, are moving to California, specifically Southern California, places like San Diego, that's causing our home prices to go up even more and even faster, and will continue to do so. In fact, just our local Fox 5 had an article about some Californians leaving for Texas are being replaced by Texans moving to California. And that was a big story that kind of flew under the radar last year, but that's what's causing the migrational shifts affecting home prices. So let's take some look at a few points of recent data and some forecasts. First of all, foreclosures, the F word. It's not even a thing anymore, guys. Foreclosures might have been big like 10 years ago in 2012. Not a thing anymore. In fact, coming out of 2023, we saw foreclosures hit a nearly all-time record low because homeowners have so much equity in their property, they just don't need to foreclose. Home price movement. As of last fall, which cities had the highest month-over-month appreciation? We're specifically looking at August, and you see from the East Coast to the West Coast and every major city in the Midwest, when you look at America's top 20 cities, there is no city that appreciated last fall more than San Diego. Again, everything I'm talking about tonight is going to be little data points, like pieces of a puzzle that fit together. And when you get all these little data points and you look at all the puzzle pieces put together, they paint a picture that make you realize what's really going on in the real estate market. I already mentioned that folks are moving to California, moving to San Diego from places like Texas and the East Coast. And I also mentioned who is moving. You see, it doesn't matter how many people move, it matters who moves. And it's home buyers. It's well-paid folks moving into San Diego. And that's why amongst every city in the United States, San Diego, month over month in August, saw the most appreciation at 1.7%. For the second month in a row last fall, we saw home prices trend higher in every single one of the 50 largest US markets, mirroring a sharp reacceleration on a national level. So last fall, why is this so important, guys? And how come I'm talking about last fall when you're really here to listen to things about 2024? Because last fall, we saw some of the highest interest rates we had seen in our lifetime, certainly in over 20 or 30 years. And with the highest interest rates in over 2 decades, we still saw some of the most massive appreciation we have ever seen. So we are gone from last fall now, and we're in 2024, and pretty soon it's going to be the spring, and interest rates are going down. So you tell me, if we saw massive appreciation in a city like San Diego with all-time high interest rates last fall, what's going to happen when we move into the spring market and we see interest rates trending lower? Home prices are going to skyrocket. Now, we get banged on a lot out here in the West Coast, people giving California a hard time. But if you take a step back and you look at not just California, but all of the coastal states, Washington, Oregon, and California, you see that again, last fall, they appreciated in just 1 month, 1.1%. Again, topping the records throughout the United States when you look at every major region in the US. Now, this is an important slide. And this is an important slide if you are thinking of buying real estate this year. You have about 60 days. From today, you have about 60 days to go out there and buy your property this year before having to pay too much more. Why do I say that? If we look at a 50-year, 49-year timeline, almost 5 decades, from 1973 to 2022, and we look at how much does real estate appreciate each month, you can see this chart and you easily see that most appreciation every year happens between the months of March to August. Then from September to February, we don't see much appreciation. So why am I sharing this with you? Let's say maybe one of your New Year's resolutions this year was to go out there and buy your first house, maybe your first investment property, maybe your second home. If one of your New Year's resolutions in 2024 is to buy real estate, I implore you to buy in the month of January or February. Once you start getting into March, and God forbid if you buy in April, May, June, or July, you will pay more money. It's statistically proven. And as we see in the chart in front of you, you might think, well, I'm just going to wait until the fall because then prices go down. They really don't. Look at September, October, November. Prices still go up, just not as much. For this reason, when I personally buy real estate, I usually buy it in the winter or certainly before we get into April. Now, if you're planning to buy a month in the next 12 months, there's a lot of competition of home buyers. And this is people that don't yet own a home, but want to someday. A full 17% responded that they do plan on buying this year, sometime within the next 12 months. And I showed you how much home prices usually appreciate month over month. What you're looking at right now is a national forecast of how much home prices are expected to appreciate year over year. Now, as you look at these numbers, you see 2, you see 3, you see 4, and you might be thinking, well, they don't look that high. Didn't we just see a chart showing San Diego is expected to appreciate by over 5% this year? And you'd be correct. And that's the difference between looking at local data and looking at national data. When you look at real estate, you have to really focus hard on local data, in our case, San Diego, because national data is always going to be just that, a broad-based average. And your market could go down. It could go up a lot. It could go down a lot. It could stay flat. It could do what the national average is. But the national average in the United States this year is 2.17% appreciation. But as you saw earlier, the average appreciation for San Diego County this year is forecasted to be over 5%. And as I mentioned before, San Diego almost always appreciates at a faster rate than what the United States does as a whole. But let's say you buy just your typical home in the United States and it just appreciated 2, 3, maybe 4% a year. How would that change your net worth over just a 5 or 6 year period? Well, if you bought something today, or let's say you just bought something in December for $400,000 and you held on to it for 5 years and you didn't even do any work to it. You didn't do any improvements, nothing. Just from appreciation on the national level, your net worth would go up by over $71,000 in 5 years. That's the median household income in San Diego. So you're making pretty much a year's pay by doing nothing other than owning real estate. Now in San Diego, where appreciation is closer to 5%, that number is going to be well over $100,000 increase in net worth. It's this reason that we're seeing the gap in net worth widen between homeowners and renters. There's a number of analogies we're going to draw between homeowners and renters today. This is just one of many charts. But as you can see, the wealth gap is getting wider and wider, and that gap is primarily be driven by those who have houses and those who do not. And let me be very clear when I say this. If you are a renter, you are technically homeless. You live in a home, but you don't own it. That home is yours as much as a rental car is when you rent a car at the airport. The only way to ensure that you have permanent housing for the rest of your life is to own it. And also the only way to ensure that you can ever reach financial security is to own what you live in. And as you can see by the wealth gap in front of you, not only does it lead to financial security, but it also leads to a significant level of net worth just by owning real estate. And folks, these are national levels that you're looking at in front of you. When you look at San Diego levels, you might as well multiply this by 2 or 3, because you all know the median price of a home in San Diego right now is around $1 million. That's a single family home. For a condo, it's closer to 600,000. But your average homeowner in San Diego has a net worth well north of $500,000. What else do we have to look forward to in the next year? Unemployment. Unemployment has hit near all-time record lows, around 4%. And you can see the average going back 75 years is 5.7%. So as long as we stay below 5.7%, which all analysts are predicting we will stay below for the next year, things should be looking good for employment, which drives the real estate market, which again, if you're a buyer, drives the competition. So with all that said, let's get into some of the economics and data that affects home prices. The next 2 slides are really all you need to see to know what's affecting home prices, because one of these slides is going to be the demand slide and one is going to be the supply. This slide is obviously demand, human beings. So what are we looking at? You're seeing every major generation in America, and the largest generation right now, millennials, followed by post-millennials, Gen Z, are hitting their 30s. Why is that important? Because it's typically around the age of 33 that people start buying homes. They get married, they have babies, and they go buy their first home. And as of today, millennials, this large generation, is starting to age into their early and mid 30s and buy homes. Right behind them, post-millennials, Gen Z, is an even larger generation, and even more Gen Zers want to buy homes than millennials. So we have this huge wave of demand coming at us when it comes to housing. And it's this huge wave of folks that have been born in the last 20 or 30 years aging into young adulthood. So there's the demand side of your equation. Let's look at the supply side. We were in last year, 2023, any given day, we had around 980,000 homes for sale. Now, as you can see, we usually have closer to 2 million, certainly well above 1 million homes for sale. Many analysts say we got to have about 1.8 to 2 million homes for sale to have a balanced market. And you can see last year, we were at record low inventory numbers of the supply side of the equation, the number of homes for sale. Well, if you stack these 2 charts on top of each other, you can see that we have what you would call the perfect storm. And it's a perfect storm because you have the highest amount of demand really in American history, these 2 big generations, millennials and Gen Z, intersecting with the lowest level of supplies we have ever seen in our lifetime. And when you have the highest level of demand intersecting with the lowest level of supply, it doesn't matter what the product is. In this case, it's housing. But no matter what the product is, it could be food, it could be gas, it could be housing, you're going to have prices dramatically rise and stay high, and they will not crash. And how can I say that so confidently? Because in 2006, 2007, we had the complete opposite problem. You see, in 2006, one of the smallest generations, Gen X, was hitting 33, and we had overbuilt and we had more supply than we ever had in human history back in 06 and 07. And because we had a lack of demand and way too much supply in 2006 and 2007, we had a housing crash. The opposite thing is happening now. We have too little supply, way too much demand, and as much as homes crashed in 06 and 07, they're going to skyrocket for the next decade or so. What does this mean for you, and how can you take action on this? Well, if you're thinking of buying real estate and you're thinking of buying that first home and you heard from somebody that home prices are going to go down, you heard wrong. prices are going to continue to go up. Number one, don't wait. And number two, buying real estate today and holding it for the next 10 years or so not only gives you a stable place to live and raise a family, but it gives you one of the best investments you could probably ever make. Because when you invest in something that has low supply and high demand, your investment is about as safe as it gets. Now, I mentioned there's a lot of millennials that are turning 30 and mid 30s now, and Gen Z right behind them. That would be a big problem if that's all it was in itself, but it's compounded because a large portion of these millennials and Gen Zers didn't move out of home yet. You see, I'm kind of a Gen X or older millennial. I was born in 81. And before me and during my generation, a lot of people would move out of home by the time they turned 28 for sure. And they'd be buying their own house, moving on. But as you can see, over 20% of men and nearly 12% of women in this age group still live at home. So not only do we have a large cohort of the demand side, millennials and Gen Zers, but a lot of them stayed at home and they haven't even gotten into the rental community yet. Meaning not only are home prices likely to go up, but we're also going to very likely see rents go up as these folks age out of their home. And it's also, as I mentioned, compounded because of the lack of inventory. And the lack of inventory comes down to two things. One, we just haven't built enough. We have not built enough real estate in the last 10 to 20 years. And number two, most homeowners do not want to sell. Because as you can see in the chart in front of you, over 81% of homeowners have an interest rate below 5%. So why would they sell one home to go buy another home with a higher interest rate unless they're really being forced to? Now, we know for a fact, we know based on data, that as interest rates go down, buyer demand picks up. The chart here shows you interest rates on the left and buyer demand on the right. And we know once interest rates get above 7, buyer demand gets a little weak. As they dip below 7, buyer demand starts to pick up. When we get in the mid 6s, buyer demand's pretty good. And if we get in the low 6s to the high 5s, buyer demand is strong. So how do you take this knowledge and use it? Buy when there's very little competition. If you wait, I already showed you a chart that shows in the spring, home prices go up a lot. March, April, May, June, July, you'll see home prices go up a lot. So if you wait, you're going to pay a higher price. Also, if you wait for mortgage rates to continue to go down further, you're going to have a lot more competition. You're going to have a lot more competition, which means you might lose out on your dream property. And even if you get your dream property, you're going to pay a lot more for it because of the heightened competition. And research has shown that most homeowners that don't have to sell and have an interest rate below 5% are likely not going to sell until interest rates get around 5.5% to 5%. And I showed you that's not going to happen for at least 2 years. And you probably don't want to wait 2 years to buy your home. So where are interest rates going to go from here? Well, there's a lot of projections from various entities, Fannie Mae, MBA, and NAR. So let's take a look at the averages on the far right. They're not too far off. They expected 2024 Q1, which we're in now, to be at 7.13. We're actually a little bit lower than that. As I mentioned, the high 6s, around 6.8 as today. By Q2, they're expecting 6.8. And it's very likely we'll be a couple of decimal spots below that, around 6.5 to 6.6. By the fall, they're expecting we'll be in the mid 6s. And as I mentioned earlier, at the end of this year, we could very well be in the low 6s, even the high 5s. Here it is just kind of in a step stool chart. And you see as we go throughout Q1, Q2 to Q3, interest rates are expected to fall about 1/4 to 0.5% every single quarter throughout the year, potentially bringing us close to the high 5s, low 6s by the end of the year. But again, what does this mean for you? Buy now before interest rates go lower. Because one unknown fact, especially amongst first-time home buyers, is you can always refinance your mortgage rate. So let's say you buy a house today and you get a 6.8% interest rate and you live in the house for 6 to 9 months. And then at the end of the year, interest rates are 6.3. You can refinance your interest rate from 6.8 to 6.3. And then let's say another year goes by and rates are now at 5.5. You can refinance again to 5.5%. In fact, one of my properties, I've refinanced at least 5 times. Every time interest rates go down, you refinance. But if you're wise, you buy when interest rates are high. And then you refinance as interest rates keep going down. Because you were wise enough to know that as interest rates go down, home prices usually go up. So if you buy now, you can buy cheaper than if you wait 6 to 12 months and still get the advantages of interest rates going down. So just how much could home prices go up if interest rates go down? Well, we already saw that for the homes out there, there's a lot of demand. There's a lot of demand, even at today's interest rates, even at the 8% and 7% interest rates that we saw last fall. There was a lot of demand because the people moving here, you showed you how many are moving here from Texas and whatnot, that have money. So if interest rates go down, how does it affect home prices? Well, the slide in front of you shows how it affects affordability. You see a $1 million house with a 7% interest rate will have a mortgage of around $5,300, but with a 6%, it's only $4,796. What I like to draw your attention to, though, is what I circled in red and the sentence on the bottom. If mortgage rates fall, home prices go up, because if someone can afford a $4,000 mortgage today, and you see a $4,000 mortgage with a 7% interest rate buys you about a $750,000 house. But let's say over the next 2 years, interest rates drop 2.5% to 4.5%. That same person who used to be able to afford a $750,000 house can now afford a $1 million house. So what does that mean to you? Does that mean all of a sudden they can go buy a way better house? No. What that means and what happens in the real estate markets is not only this one dude can afford a $1 million house, but everybody who used to be able to afford a $750,000 house can also now afford a $1 million house. And what that does to the marketplace is it drives up the value of the $750,000 house to now be worth $1 million, because that guy can still afford it. So what does that mean? A 2.5% drop in mortgage rates could potentially cause real estate values in San Diego and across the nation to climb another 33%. If we are hitting all-time high home values, when we were in an 8% interest rate environment, folks, and that happened last fall, the median sales price in San Diego was around $1 million with 8% interest rates. Now, if interest rates fall 2.5, and what's 8% minus 2.5? 5.5. And mark my word, we will be at 5.5% interest rates in the next year or two. When they drop that 2.5%, what's going to happen to home prices? They will go up about 33%. So what am I saying? What I'm saying is over the next 24 months, you will likely see the median sales price, the median home price in San Diego, go from $1 million to 1.3 million or more. So if you want to pay more money, then wait. But if you're smart and you want to buy cheaper, buy now, refinance later, and during the next 2 or 3 years, you can watch your net worth go up as interest rates go down. Now, if you're a buyer or a seller, your price point determines a lot about how much competition you have out there in the market and how long it can take to sell. So the chart you see in front of you shows you median sales price ranges and how long it takes to sell a home in those price ranges. For example, any home between 0 and 750,000, average days on market is 52 days, It makes up 33% of inventory, but 41% of demand. So what does that mean for you? If you're buying a home that's 33% of inventory, 41% of demand, you're going to have a lot of competition. And you got to be aggressive with your offers. You got to get in there and you got to work with a good real estate agent that can get your offer accepted in a competitive environment. In fact, that's true all the way up to about 1.5 million. It's around 1.5 million that we start to see the market balance. 8% of supply, 8% of demand. And of course, anything above 1.5 million takes a little bit longer to be able to sell. But you really got to understand this when you're looking at the market price you're going on. So what should you do? I think you know the answer to this. I think you heard me say the answer a few times. But what you should do is buy now while real estate values are relatively low compared to what they will be in the future. And what are some ways that you can take advantage of not just a little bit less competition now and lower prices, but also try and get a lower interest rate? There's two big things I'm seeing a lot of our clients do that you should do as well. Number one, a 2-1 buy down program. What's a 2-1 buy down program? Well, let's say interest rates today are 6.8%. But I just showed you a lot of data and slides showing you that interest rates are likely going to go down in the coming years, quarter after quarter. So you can get the seller to buy down your interest rate today. And we're seeing that happen all the time. What the seller does is we get them to buy down your interest rate for 2 years. And then in 2 years, you refinance anyway into what is going to be the new lower interest rate on the market. So instead of getting maybe a 6.5% or 7% interest rate today, you can buy a house today with like a 5% interest rate. That's the 2-1 buy down program. And then in the next year or two, you refinance into the lower rates that are standard on the market. The other program that we're helping a lot of clients with is down payment assistance programs, also known as grant programs. Now, last year, my team got our clients over $400,000 in free money from the government that our clients were able to use as down payment to buy homes. And if you're a first-time home buyer, which by definition is anyone who hasn't bought a home in the last 3 years that you live in, if you're a first-time home buyer, I can almost guarantee you that we can get you free money. And by guarantee you, we just got to make sure that you qualify based on your job. But if you got a decent job, you follow the qualification parameters, there's good odds we can gift you 10, 20, 30,000, maybe even more. We got one of our clients $100,000 last year to buy your first home. But then you might be thinking, isn't renting cheaper than owning? Because you see the same articles and the same news out there that I read. And a lot of times you see things that show it's cheaper to rent today than it is to own. Well, let's look at some real numbers and some real data. First of all, owning beats renting every time as long as home prices rise by 3.15% per year. And this happens 70% of the time. I don't know how many of you have taken a probability and statistics course, but you probably live your life by probability and statistics, even if you don't realize it. And if something happens 70% of your time, you should make bets on it. And when we know that home values go up over 3%, 70% of the time, that tells us that owning beats renting the majority of the time. And as you know, in San Diego, home prices often go up much more than 3% a year. This is simply national data, not San Diego. There's another article that came out. You see here, it was called Buy or Rent. And this journalist that follows the economic markets and the housing market, he and his team built a very in-depth Excel model. I built one too, which I'll share with you in a minute. But their Excel model showed that in the United States, buying beats renting every time by year 4. If you're going to live somewhere for at least 4 years, or even if you're not going to live there for 4 years, maybe you're just going to live there for 1, 2, or 3 years, but then you're going to keep the property, turn it into a rental, put a tenant inside, and make a little rental income. As long as you own that property for more than 4 years, as the article showed, owning beats renting. Now, let me get a little bit deeper with you and ask you a question and then show you some real math. What if you could rent a place for $3,000 a month, or you could buy and own the exact same place for $3,990 a month? Which would you do? Knowing only this information, most of you would say, well, I'm going to rent because 3,000 is cheaper than 39.90. I wouldn't disagree with you. 3,000 is cheaper than 39.90. In most news articles you see, this is where they stop with math. You see, when I was a kid, I was bad at English, but I was really good at math. And I believe math to be the universal language. So whenever I see a question, I like to drill down and do as many mathematical formulas as possible and then come with an answer. The unfortunate truth is, in the United States of America and most other countries, most people don't like math, and they stop at this sentence: 3,000 a month versus 39.90 a month. And most journalists and most people will say, well, it's cheaper to rent, but they couldn't be further from the truth. In this answer, when you drill into the math, you will see that 3,990 is a lot cheaper. Now, I'm showing you an eye chart right now, and this is probably making some of you want to cry. So let me kind of cut to the chase. This is an Excel spreadsheet. I built it when I was in grad school, and it shows a mathematical reality between someone who wants to rent a place and someone who wants to own a place. Now, all these small numbers on the right, those are all the calculations going out for 30 years, 360 months. Why did I go out 30 years? Because that's the length of a mortgage. But what we're going to zoom in on is the top left. So let's zoom in on the top left, because the top left is really where the answers come from and the inputs. Now, for any of you who have ever used an Excel spreadsheet, and for those of you who haven't, here's a little refresher. Anything in blue is a variable that you type in. So let's say you're a renter, and many of you probably do rent. And if you don't rent, you're going to love this as well, because they're going to show you a lot of value for your ownership of a house. But if you are renting right now, you really got to pay attention. Let's say you're renting a property in San Diego, and let's say that property is worth $500,000. That's a typical price for a condo in San Diego. Now, let's say your rent is $3,000 a month. That's typical rent for a condo that's worth about $500,000. And we all know in San Diego, we have rent control, and your rent can go up between 5 and 10% a year, somewhere between 5 and 10%. Now, most years it's probably going to go up more than 5%. But let's say you have a really nice landlord and they only raise it 5% a year. So if you're that renter, I've got all your inputs down here in the bottom. Buyer's rent, $3,000. Annual rent increase, 5%. Now, let's say you could buy this property for $500,000. And let's say you could buy it with just 5% down. Well, that would be $25,000. So, and here's the cool thing. You don't even need to put all that down, because the odds are I can get you that $25,000 for free through down payment assistance program. So you get $25,000 from the government. You put down 5%. And let's say your interest rate is 6.5%. You can get that interest rate today. It's pretty feasible. And let's say your taxes are 1.25%. You see that in the top right. You have insurance of $800, HOA $400 a month. How much are you going to pay as an owner? We already know the renter's paying $3,000. As an owner, with these assumptions, you're going to pay $3,990 a month. And that is your principal, interest, taxes, and insurance. All the parts, oh, and your HOA, all the parts that make up a mortgage. And again, most people would stop doing math at this point. And they would say, well, it's cheaper to rent than it is to own, so I'm going to rent, because $3,000 is a lot cheaper than $39.90. I don't fault people for that. That's easy math. $3,000 is cheaper. But anyone who decides to rent after seeing this much math is making the biggest financial mistake of their life. Why are they making the biggest financial mistake of their life? Well, let's get into a little bit deeper math. How much does each pay over 30 years? Now, I am going to assume you're going to live a long time. I'm going to assume you're going to live another 10, 20, 30 years, maybe even longer, and I hope you do. But over the next 30 years, if you own the property and you paid your mortgage every month, you paid 1.597 million. Now, if you rent the property and you started paying 3,000 a month, and your rent went up every year by just 5%, over 30 years, you're going to pay 2.391 million, almost 2.4 million. So as a renter, well, you think you're getting away paying less. You are the first year, but within a few years, you're actually paying more. And within a decade, you're paying a lot more. And over 30 years, you pay almost $800,000 more than you would have had you owned it. But that's not the worst part. That's not at all the worst part. The worst part is the next two things. You see, after 30 years, you're still alive. Maybe in your 60s, you're in your 70s, you're in your 80s. And after 30 years, how much are you paying year 31 if you're the owner? How much are you paying year 31 if you're the renter? You see it right here. If you're the owner, your mortgage is paid off. So now all you got to pay is taxes, insurance, and your HOA fee. That adds up to $2,042 a month. Now you can retire. You're in your 60s, your 70s, your 80s. You can retire because you can easily live on a fixed payment of $2,000. But if 30 years ago, when you were in your 20s, your 30s, your 40s, back in the year 2024, if you made the biggest financial mistake of your life and you thought it was cheaper to rent than it was to own, guess what you're paying 31 years later? Over $12,000 a month. How does $3,000 a month become over $12,000 a month? It's math. That's the power of compounding numbers. $3,000 going up 5% just once a year becomes $12,000 a month by year 31. And you will never retire. If you choose to rent today, you are destroying your financial freedom and security of the future you. And you can see that in the math in front of you. This is about the worst part. For the owner, though, it gets even better. You see, if you buy a $500,000 property today and it appreciates at 6% a year, well, that means next year it's worth what? About 530,000. The year after, about 560. That's not a lot, but after 30 years of $500,000 property compounding at 6% a year, the property is worth a lot more than 500,000. It's worth a lot more than what you paid into it, the 1.597 million. In fact, it's worth over $3 million. A $500,000 condo today that goes up in value just 6% a year after 30 years is worth over $3 million. And congratulations, you're now a multimillionaire. And relative to the renter who paid 2.391 million and ends up with nothing, you paid 1.597. You had a place to own, a place you called your own. You're now worth over 3 million and you're living for $2,000 a month for the rest of your life. That's the difference between renting versus owning. And this math in front of you is why when you read an article that says it's cheaper to rent than it is to buy, stop reading the article. Words lie. Look at the math, and the math will show you the truth. That, as I like to say, the only people in America that can afford to rent are the wealthy, because renting is the most expensive way to live. Owning is the cheapest way to live. The problem is most people don't like math, and most people stop at the first thing I showed you, and they don't drill into it. You need to own real estate if you ever want to be financially secure. I also like to show this chart in front of you. Let's say you want to buy $1 million property, and that's a median home. I showed you a condo example. Now let's look at a single family home example. Let's say you got $50,000 and you're wondering, what should I do with the $50,000? Well, you could buy $1 million home, put down 5%, or you could invest it and get like in the stock market. Now, the stock market usually gives you about an 8-9% return. But let's say you found a really good stock and you got a 12% return year over year for 30 years straight. First of all, that's not going to happen because there's no stock that's given a 12% return year over year for 30 years. But let's say you're lucky and you do something that's never happened. If you invest that $50,000 into a 401k, an IRA, or anything else that gives you a 12% return year over year, after 30 years, you see in blue, that $50,000 becomes 1.497 million. Not bad. But if you use that $50,000 to buy a $1 million house, and that house goes up just 6% a year, year over year for 30 years, that house is now worth 5.743 million. And you can see the difference between these two investments, between the green line and the red line on the far right. This is why real estate is one of the best investments in the world. And this is why over 90% of millionaires made their millions in real estate. Because I'm telling you right now, you were probably born being told that the only way you can become a millionaire is to win the lottery. Or maybe someone told you the only way to become a multimillionaire is to win the lottery. I'm telling you, one of the easiest ways to become a millionaire, even a multimillionaire, is to buy some San Diego real estate, own it for 30 years, and now you're a multimillionaire. And I just showed you that with a condo example, and now you're seeing it with a house example. This is the power of math, the power of real estate. And as we see in the chart in front of you, home ownership isn't just something that can give you financial security, give you a long-term place to live for the rest of your life. It's better than renting financially, but it also gives you a great hedge against inflation. When you look back 50 years to the 1970s, you can see the average decade inflation rate, each decade in blue, and the average home price appreciation rate in green. And it's pretty easy to see that homes often not only keep up with, but outpace inflation. There's something else that outpaces inflation though. And what is that? That is rents. Another reason. I've got a million reasons, but just another reason to not rent. You see, rents usually go up faster than inflation. The rent line is in green, the inflation line is in blue, going back again the 1970s. So if you rent instead of owning, you're getting a double whammy because you're not only not getting the advantage of home appreciation, but you're seeing your rents typically go up faster than the rate of inflation. So what do the experts think is coming? We've gotten out of a lot of inflation. It's starting to subside. Is there going to be a recession? Well, in October of 2022, most experts thought there would be a recession. 63% thought there was one on the horizon. As of this last October, just a few months ago, the tide is turning, and the majority of experts now, 52%, are predicting there will not be a recession. Well, what does that mean for you? If there's not a recession, interest rates will likely keep on going down. Home prices will keep going up. But if there is a recession, interest rates will go down even faster and home prices will probably keep going up, maybe even faster. Well, how can I say that? How can I say home prices go up if there's a recession and if there's not? Because the data. You see here, when you look in front of you, history has proven that a recession doesn't equal housing crisis. In fact, the majority of the time we have a recession, home prices go up. 4 out of the last 6 recessions, home prices went up. And why is that? Because recessions mean falling mortgage interest rates. 100% of the time we have a recession, the Federal Reserve lowers rates. Rates going down for mortgages usually mean prices go up. So if I was you and you're thinking of buying a house, I wouldn't worry too much about a recession. Because if there's not a recession, interest rates are probably going to keep going down and home prices are going to go up. If there is a recession, interest rates are going to go down and home prices are probably going to go up. The story for housing is the same regardless of a recession or not. Now, there's a study that Zillow came out with last year. Where in the nation are home prices going to go up the most? And as you can see, those areas in blue, primarily coastal and some in Texas. And of course, you got Nevada and Southern California, we can see are the areas where home prices are expected to go up, including our region, San Diego County, way out here in the far west. But what about beyond this year? Again, analysts were polled 2024, 25, and 26, and 86% are expecting appreciation this year. 91% expecting appreciation next year, and a full 96.8%, almost 100%, are expecting appreciation in 2026. So the next 3 years plus, most housing forecasters are expecting us to see appreciation, no crash in sight. The longer you wait, the more you will pay for real estate. So buy now before it goes up further. And in San Diego, the supply-demand equation is more far off than just about everywhere else in the nation. And that's why we're seeing home prices go up dramatically more. Buying in San Diego is a good decision. I would say why, but why? Let me show you the data as to why. And we all know it comes down to supply and demand, and the supply in San Diego has been grossly neglected. In fact, we need to build so many units that over the years, going into 2021, and the deficit's even built bigger, we had a 78,000 plus unit shortage. We needed to build 15,000 units a year just to meet our growing demand of our population. And we have undershot that growth of units by quite a bit. Also, not only do we have a lack of supply, but the demand side, the value of real estate is very much based on the economy. The economy is based on the people, and the people create the demand side. So what is going on in the San Diego economy? As you look back to 2010, usually about $1 billion of venture capital investment came into the San Diego region every single year. That started to change in 2016, and it really started to accelerate in 2020 and 2021 following the pandemic, when in 2021, for the first time, we saw $9 billion of venture capital money coming into San Diego. And why is that? Because San Diego is one of the largest biotech hubs and fastest growing biotech regions in the world. And obviously, coming off the pandemic, biotech became a more front burner issue to society, and thus a lot of money started going in that direction. We can see here just in San Diego County, the majority of the money, over 5 of that 9 billion, went into the life sciences, but not to exclude tech. A good $4 billion also went into our tech industries. When we take a step back and we ask ourselves, well, how does this compare San Diego to the rest of the nation? We see the rest of the nation right here in the eye chart in front of you. When you look at the top growth cities, and by growth, I mean biotech and venture capital growth, which cities that are growing in a venture capital sense, which cities are growing the most? And you see San Diego tops them all. Seattle, DC, Denver, Austin, Chicago, Miami, and Atlanta. There's no city with a tech future focus that is receiving more money and more growth than San Diego. Again, one of the many reasons I think San Diego is one of the best places to invest your money, San Diego real estate. And where are we seeing it come to fruition? A lot of places, a lot of developments in San Diego County that are well north of $1 billion in development. One of the biggest is the IQHQ San Diego Research and Development District, right in downtown, kind of by the Seaport Waterfront Village area across USS Midway at $1.6 billion. This is the largest waterfront biotech space development on the entire west coast of the United States. And just a block away in the Seaport Village area, we have a huge redevelopment that's going to be undertaken in the next decade at a price tag of $3.5 billion. Now, as we go a little bit more further inland towards Mission Valley, we see the SDSU Mission Valley Innovative District that has a $1 billion price tag. And this is going to be not just student housing, not just a new stadium, Snapdragon, that many of you have probably already been to, but a lot of incubator spaces for venture capital money and students working in the biotech space to create tomorrow's technology. And in the same region, Mission Valley, we have one of San Diego's biggest real estate developments happening, a $4 billion project in the Riverwalk, San Diego area that's bringing not just new apartment buildings, but also thousands and thousands of square feet of retail and millions of square feet of office space in the Mission Valley region. And of course, you've probably already heard the news, but Apple is moving down here to create a new engineering hub based out of San Diego with over 5,000 new jobs within the next 2 years. And they made this a permanent decision by buying a $500 million brand new Apple campus here in San Diego County. As you come back into our inland, just south of Mission Valley, you see UCSD Hillcrest is building a new $2.5 billion hospital complex at UCSD Hillcrest. And just 4 blocks away, we have another $1 billion plus hospital, Scripps Mercy, building a new campus at the original Scripps Mercy site. As we go further south, you see a $2.8 billion, the largest, most expensive waterfront development happening on the West Coast right now is the Chula Vista Bayfront development, which is going to have state-of-the-art facilities, including a brand new convention center, second in size only to the downtown convention center, beautiful hotel resort that you see a photo of here, along with more retail, office, business park, and apartments. And as you go again inland down in South Bay, you see Amazon in the last year or two created the largest Amazon facility in the entire state of California, based right here in San Diego. And the largest development of all of them happening right now, you see it every time you drive by Harbor Drive, is a $2.7 billion new terminal project at our airport. Because with all the economic growth in San Diego and all the biotech and venture capital money coming into our region, business is growing faster in San Diego than it ever has in history before. Business and the economy in San Diego is growing faster than just about every other city in the United States. And because of this and the type of people San Diego is now attracting, you will see San Diego values continue to soar and certainly continue to hold. And unlike most other cities, including those in the Midwest, there's nowhere else to build. Think about it, guys. You can't build north. We have Camp Pendleton to the north. You can't build east. We have the Cleveland National Forest. You can't build on National Forest. You can't build south. We have Mexico. And you can't build west. We have an ocean. There's nowhere else to build. And unlike every other city in America, San Diego is all but landlocked, meaning what we do have will continue to hold and increase in value. Beyond all these civilian economic incentives and investments, the billions of dollars being invested in San Diego, we also have one of the most robust military economies in the world. A very unknown fact is, well, U.S. military employs well over 100,000 people in San Diego County. 15,000 people get off active duty in San Diego every year, and over half of them remain in our region. And it's not just the people in San Diego that give a strong impact, it's the money coming from the Department of Defense. In fact, you all know, because you've read it before, I'm sure, the United States spends more money on the Department of Defense than like the next 10 countries combined. And the number 2 recipient of United States DoD dollars is none other than San Diego. So with all the Department of Defense money flowing into San Diego, with all the venture capital and the biotech money flowing into San Diego, and with all the highly educated, highly compensated people from Texas and every other state in the nation moving to Southern California and cities like San Diego, what do you think is going to happen to real estate prices in San Diego? San Diego's downtown has grown back faster than any other city in the United States. And San Diego ranks top 5 in a lot of categories and top 1 in a fair amount. This is one of them. When you look at all the cities in the United States, there is no city's downtown that has bounced back more or faster than San Diego's downtown region. Additionally, With San Diego's growth, it has quickly become one of the most sought after destinations in the world. And the United States is the third ranked destination city for people looking to move to a different city. In fact, just a year ago, there was a study done on what are the top 10 metros in the United States that folks want to move to. And you can see here San Diego ranked number 3, right behind Miami and Sacramento. You might think, well, why is this? Because I thought everyone's moving out of California. Guys, everyone's moving out of Northern California. Northern California is the primary region losing people. Southern California, which is like another state of its own, is gaining people, specifically San Diego. And as I mentioned before, when it comes to home prices, it doesn't matter just how many people move. It matters who moves. There was a study done in the summer of 2002, and they looked back at a 3-year period from 2019 to 2022, when a lot of people were moving, disruption, COVID, everything was going on. And none other than LinkedIn conducted this study. Why? Because LinkedIn knows everyone's education level, everyone's location, where they live, what their job is, what their job title is, and sometimes even how much money they make. So no website knows better than LinkedIn where is talent moving to. And as you see in the article here, LinkedIn's research showed them that there is no city that is growing proportionately faster in tech talent than San Diego. You see how I talked about at the beginning of tonight's presentation, there's all these puzzle pieces. Every piece of data is nothing but a puzzle piece to answer the question, what's happening to San Diego real estate and what is likely to happen to San Diego real estate? And when you add up all these puzzle pieces from who's moving, where are they moving to, how much have we not built in real estate? Where's tech talent moving to? How much biotech and venture capital money is coming into San Diego? How much military money is coming here? We can't build because we're landlocked. All these puzzle pieces. Interest rates are going down. At all-time high interest rates, we hit all-time high home prices, and now rates are going down. You put together all these puzzle pieces, guys, and it paints a picture. And what the picture looks like is San Diego real estate values skyrocketing in the next 2 to 5 years beyond the levels we're already at. And you heard me say today that if interest rates go down into the low 5s in the next 2 years or so, we'll likely see San Diego median home prices around 1.3 million. That's why articles like this one started coming out. San Diego real estate is one of the safest, most secure investments you can make because across the nation, San Diego homeowners are the least likely to sell at a loss. You also see the myth dispelled. People aren't leaving San Diego. They're not leaving California. They're leaving Northern California. On this chart, this map, wherever you see pink and red, people are moving out of those areas. Wherever you see green, people are moving into those areas. As I mentioned before, Northern California, yes, people are leaving, but Southern California is gaining people. It doesn't get darker green than what you see here in the bottom left of your map. And as much as people are moving to San Diego, we have not built enough housing. I love this chart because it shows the raw data. And between 2003 and 2021, we needed to build over 21,000 homes a year just to meet our housing needs. 21,460. That's how much we needed to build a year. Yet since 2015, we built only 9,027 average homes per year. Less than 50% of what we need to build, we're building. I'm telling you, folks, when San Diego's population has grown by over 250,000 in the last 10 years, and in the last 10 years, we built less than 50% of the housing we need to build, what do you think is going to happen to home prices? They're gonna go up. And that intersection, guys, let's look at 2015, 2017. I showed you the puzzle piece of when biotech and venture capital money really started coming into San Diego. 2017, 18, 19, but it really started coming in around 2020 and 21. Our biotech boom began in 2017, and it just kept growing and growing. The household growth began skyrocketing in tandem with the biotech boom. Why is that? Because it's the biotech employees moving to San Diego. It's the biotech employees, yes, moving here from Texas and every other state in the union, that are causing home prices to go up. And at the same time, household growth started gaining a lot of traction in San Diego. We started building less real estate. And you can see that diving in 2020. So with all these puzzle pieces, if you don't believe me, believe one of the most famous women on Shark Tank, Barbara Corcoran, who's a self-made real estate millionaire. And as I mentioned, over 90% of millionaires self-made it by owning real estate. And I showed you math, I showed you Excel spreadsheets on how you can become a multimillionaire by just buying a $500,000 condo and then doing nothing but live in it. But what Barbara says here, and she said this last year, it still holds true even though rates are going down already. But she said it's a good time to buy because the minute interest rates go down, everybody waiting for them at that point is going to do what everyone else does and come rushing back into the market. When everybody comes rushing back in, prices are going to explode. You're going to be paying more for the same house. And as she mentions, and I told you at the beginning, you can always refinance your mortgage when interest rates go down. So if you're smart, and I know you're smart, you're going to buy now, and you're going to buy before the spring. Because as you saw in a previous slide, prices really start to go up a lot March, April, May, June, July. And by the time you waited there, I'm telling you, you can still buy. You're just going to pay more money. So the wise thing to do is buy now, save yourself a little money. And I hope this advice does save you money. And if you're one of those out there listening and you're renting, you're in a bad city to rent, folks. In fact, if you look back over the last 3 years, look at the far right. Cities over the last 3 years that have had the highest percentage of rent growth. San Diego's right up there in the top 10. In the last 3 years, we've had 29% rent growth. Now, when I built that Excel spreadsheet, I pretended you had a nice landlord that only increased your rent 5% a year. And you saw after 30 years, you're now paying $12,000 a month in rent when it was 3. Well, imagine if you have a normal landlord that raises your rent closer to 10% a year, as most landlords do. And you see in San Diego in 3 years, almost 30% rent growth. In fact, because of the last 3 years, San Diego now has surpassed San Francisco as the most expensive city to rent in, with a median rental rate well over $3,000. But I'm not surprised. In fact, every time I fly into San Diego and I see the beautiful weather, the beautiful city, and all the job opportunities here, I ask myself, why is San Diego not more expensive? After looking at my own presentation that I put together every month, I don't ask myself, why is San Diego so expensive? I ask myself, why is San Diego not more expensive? And mark my word, because of not just the weather, not just the biotech, not just the military, but a culmination of all these things that no other city has. You will not find another city in the world, let alone the United States, that has the combination of weather and biotech growth and military spending that we have here in San Diego. And that, my friends, is why San Diego should be even more expensive than what it is. But lucky us, it's 2024. It's not yet 2025 and 2026. If you wait till then, you will pay more. Today, you can still buy it relatively cheaper than what you would if you wait. Now, we've just got a few more slides to go, and then we're going to look at Q&A. But I want to end it on a couple of things. You're probably like most people out there, and most people get caught up in these surveys. And a survey was recently done by bankrate.com, and it asked Americans, what is the number one thing you want to accomplish in this life? The number one American dream thing you want to accomplish? And more than college, career, or being able to retire was owning a home. Owning your own slice of this world is still the American dream. Owning a home where you don't have to worry about a landlord raising your rent. You don't have to worry about getting kicked out because the landlord's going to sell your place. You don't have to ask someone for permission to paint. That is for obvious reasons the American dream, because nothing gives you freedom or financial security like owning the house you live in. And when you look at the younger generations, the millennials and the Gen Z, almost all of them want to buy a house. I showed you previously the charts that showed these are the largest generations in American history. They're hitting their 30s, first time home buying age. And over the last decade, we've built less housing than any other decade. We're hitting the perfect trifecta storm of the least amount of housing ever built, the biggest generation hitting their 30s, and 95.5% of them want to buy a house. This data all but ensures home prices are going to continue to go up in value. And when asked, why do these people, why do millennials, why do Gen Z, why do you want to buy a house? The majority of them say emotional, lifestyle reasons, a pride of ownership, and a place for me and my family to call home, a retreat, if you will. And then the other 39.7, almost 40% say financial and rational reasons. And that's why when I give my presentations, I show you both sides of it. The lifestyle and the emotional reasons are super important, but you also got to be able to rationalize it. You got to be able to look at the numbers. You got to look at the math. You got to look at the finance. And I hope I answered both of those sides of the question today. What I haven't answered yet, though, is how do you do it? When surveyed, Gen Z has 5 top reasons why they don't buy a house. And millennials share these reasons. Number one, the biggest, not having enough money to save for a down payment. And I already told you, you do not need a down payment to buy a house. There are over 20 down payment assistance programs in California where we can get you money for free as long as you qualify for the loan. If you qualify for the loan, the down payment's the easiest part. We can get you a down payment assistance program to cover your down payment. So that wipes out concern number one. Concern number two, not knowing where to begin. 20.8% of people, they don't know where to begin. Where you begin is where you are right now, being educated, being informed, attending a webinar like this, learning more about the real estate market. And if you seriously want to buy a house this year, the best place to begin is shoot me an email. I'll share it with you again at the end of tonight's presentation, but send me an email and say, hey, I saw your presentation. I want to buy a house. I'm interested in that down payment assistance, and I'll get you started and we'll help you find that home. And then finding a home in the price range. 100% of the clients we work with, we find homes in their price range. Not having good enough credit, give me 3 months and I can get your credit as high as it needs to be to get you to qualify for a loan. There's things you can do with your credit score to get your credit up. Having too much student loan debt, lots of people, in fact, almost everybody buys a house with existing debt. You can have a car payment, credit cards, student loan debt. That's okay. It shouldn't stop you from buying a house. That's why you went to college, so you could buy a house. As I mentioned, there's a lot of programs coming out within the last year to help people buy homes. One of them is the Federal Housing Administration, the FHA, has extended mortgages now to qualify you to buy not just a house, but also one with an accessory dwelling unit. So you can buy a home with an ADU and maybe live in the ADU and rent the house and have the tenant pay the mortgage for you. You can even use a new Fannie Mae program where you only put down 5% to buy a duplex, a triplex, a fourplex. We had one of our clients, I kid you not, we had one of our clients buy a 4-unit apartment as his first house. He lived in 1 unit. He rented the other 3 units, and the rent on the other 3 units paid 100% of his mortgage and still left him with an extra $1,000 a month. So this guy was getting paid to live in San Diego. And how much? What was his income? He made around $80,000 to $90,000 a year. But if you make around 80 to 90,000 a year and you buy the right 4-unit apartment complex, you can have the rents on the other units qualify your income for that mortgage. And as I mentioned earlier, there are over 20 down payment assistance programs. What I'm showing you right now is just a half dozen of them that are local to San Diego. But there's over 20 other down payment assistance programs that are California based. So if you're interested in buying your first home and you're concerned about the down payment, just reach out to me and we'll help you get some of that free money to buy your first home. But remember to cross the finish line. And in this case, the finish line for you is buying and owning your own home. To cross that finish line, you must first cross the starting line. And as I mentioned earlier, what does that starting line look like? It usually looks like sitting down with my team and I for a one-on-one consultation. Let us know what your goals are. Let us know what your concerns are. Let us know what your questions are. We'll answer all of them and help you buy your first house. But at the end of the day, who you work with matters. Most real estate agents don't know about the down payment assistance programs. They're not going to share with you the type of economic and housing data I just did. If you want to make the most important and largest financial decision of your life with the most professional team of real estate agents you will ever meet, then reach out to me, and myself and all of us at Kappel Realty Group would be happy to work with you. You see my email there in the top right. Shoot me an email if you have any questions or if you'd like to work with us in the future. And definitely you'll want to check out our YouTube channel to watch many other webinars like the one you saw tonight that go over a lot of things beyond market update, things about buying a first house, how to house hack, how to get other people to pay your mortgage, how to get down payment assistance, and even how to invest in real estate, like in 2 to 4 unit properties in multifamily. And with that, I'll leave it on this slide so you have my contact info, but I'm going to dive into the Q&A and answer some of the questions. I know it's just past 7, but I'll stick around and answer all the questions that came in. Looks like an anonymous attendee typed in a few questions. The first one is, home prices have dropped over the last couple of months. When will the drop stop? Home prices usually go down in the winter. It's seasonal. Usually home prices go down October through February, and then in March, home prices start going up. And it's a seasonal thing. Think of it as like going to a water park. Even in San Diego, where the water park is open, can be open all year, most people don't go to a water park in the wintertime. They go in the summertime. Same thing with real estate. Most people don't buy real estate in the wintertime. They buy in the spring and the summer. There's a very rational reason for that. Lots of home buyers are families, and lots of families have kids, and most kids are in school in the winter and in the fall. And sports are getting started, school's getting started, then you get into the holidays, the days are short, and then all of a sudden you get to March. And when you get to March, school is ending in just a couple of months, summer's coming up, so most home buyers, especially those with families, they start buying real estate March, April, May. And then usually it starts to slow down again by August. So typically, most years, we see home prices go down a little bit, at the most stay flat, maybe go up just a little bit, but usually they kind of stay flat or go down a bit around the holidays. And we'll probably see home prices really start to go back up around March. And that's why I said at the beginning of the presentation, you've got about 60 days until home prices start going back up again. So if I was buying real estate, if I was you, I would buy in the next 60 days. Another question, if mortgage rates drop to the low 7s, high 6s, will home prices increase in San Diego? Yes, and I'm pretty sure I answered that question, but as interest rates go down, home prices will go up. Another question here is, what will affect the ability to refinance to a lower rate if part of a government program? So it depends on the government program. With VA loans and FHA loans, you can refinance as many times as you want forever. My VA loan, like I said, I've refied 5 or 6 times. And for some of the down payment assistance programs, it depends on the program, but let me give you a generality. For most of the down payment assistance programs, you can refinance it at least once without having to pay back any of the down payment. Some of the down payment assistance programs, you can refi as many times as you want as long as the rate's going down. So even if you use a government program, even if you use down payment assistance, you can still refinance into a lower rate 9 out of 10 times. But again, it depends on the specific program. And for specific questions, definitely reach out to me because everyone's program, their loan, and their situation is unique. Some more questions here. What is the best way to pass down property as inheritance? A specific trust? I'm not a real estate attorney, and I'm certainly not a trust attorney. And by that nature, I'm not allowed to give advice on inheritance. What I can say is what I do. And if what I do you take as advice, so be it. But I hold my real estate in a family trust. Not a specific kind of trust, just a family trust. And when I die and when my wife dies, it'll pass on to my daughter through the trust. And thus it'll avoid probate. And unlike retirement accounts, that when you pass a retirement account onto your children and they take the money out of the retirement account, they're getting taxed usually on a good chunk of the money they take out, depending on the type of retirement account. But when you leave real estate to your children, 99 out of 100 times they can sell it at market value and not pay any taxes or very little taxes. See, real estate gets treated differently than just about everything else by the IRS. It gets what's called a step-up cost basis. But that's a topic for another day that goes on for 60 minutes. So if that was your question, reach out to me. You need a smart agent to be your client. Another person asks, any idea about the housing market trend in Hawaii? No, I don't know the Hawaii market. I've been to Hawaii like 2 or 3 times in my life, but not to study real estate. It was to drink pina coladas and lay on the beach. I do have friends who are real estate agents in Hawaii. So if you have questions about the real estate market in Hawaii, reach out to me and I'll connect you with some of the best real estate agents I know out there in Hawaii. Another thing is Apple is relocating to Texas, and I got real estate friends in Texas too, of course. Austin. How will this affect housing demand? Will other tech companies follow suit? So Apple is going to San Diego, and Apple is also opening some footprints in Austin. How will this affect housing demand? It will increase housing demand in Austin, but it will not affect prices, not the same way, at least, that it affects prices in San Diego. And why is that? Well, my friends, I grew up in the Midwest, and I know what happens when you run out of housing in the Midwest. You go to the farmer that owns a field at the edge of town, and a developer buys a field, and you build more housing tracts, and you're able to make the supply equal the demand. San Diego's not that way because we don't have a farmer at the edge of town. As I mentioned earlier, we got Camp Pendleton, Cleveland National Forest, Mexico, and Pacific Ocean. So we are not able to add supply to our housing stock the way cities in Texas can add supply. By the way, I also am a part owner of an apartment in Texas, and it's turned out to be not a good investment compared to San Diego, because we have laws in California that protect how much your real estate taxes can go up per year, capped at 2% every year. In Texas, there's no law that I'm aware of that caps how much your real estate taxes go up. And every investment I own in Texas is getting walloped because of taxes going up so much. Every investment I have in California is doing amazingly well. California has a lot of laws that protect our investments. As much as people say that we have a lot of tenant protection laws, we also have a lot of landlord protection laws when it comes to investment that make it a good state. And last question here is any recommendation on homeowners insurance that will insure California homes? If you have questions on homeowners insurance, reach out to me directly, and I've got some contacts I can put you in touch with for homeowners insurance. With that, looks like the end of Q&A. I appreciate you all joining the webinar today, and I look forward to seeing you at future webinars. Remember, check out the YouTube channel, and for any of your friends or family that could benefit from what we covered today, have them check out YouTube as well. We'll talk soon. Have a good night.